Recession seems unlikely in 2024, but in 2025, there seems to be a consensus forming where we could see it slow down. That could turn into a recession. And so that's what we'll be looking at in this video. On boombustinvest.com/crash or the financial crash page here, what I do each quarter is I go through the recessionary indicators that I see might be building up, like unemployment, or the other side of a downturn that we see is a problem with earnings going down. So I will take a look. You can come along and sort of take a look at this, and I'll explain on the page what all of these links are. But I'll summarize. What I do is summarize each quarter, and basically make a call where I think we are heading in terms of our pensions, 401ks, IRAs, ISAs, etc., where stocks and bonds are potentially heading in the coming year or years. So, and as buy and hold investors, all we're really interested in is seeing if there's a potential for a crash that's could be incoming. Apart from that, any of the smaller downturns, 5-10%, even 20%, we're not really interested in. It's only these bigger crashes like the Great Financial Crash and the dot-com busts that we're really interested in trying to avoid. And so, as I say, every quarter you can follow along. If you like, subscribe, hit the bell icon. I'll be summarizing these things and letting you know what I think for it's worth of where we might be heading. So to kick off with then, FactSet have a pretty good reputation for making good calls. So their latest release here, my laptop will start working. So given concerns, here we go, given concerns that the market is going for a possible economic slowdown, have analysts lowered the earnings per share estimates more than normal for the S&P 500. For companies for the second quarter, the answer is no. During the months of April and May, analysts actually increased earnings per share estimates in aggregate for the second quarter. So according to FactSet, earnings are in rude health for the S&P 500. The reason we look at the S&P 500, of course, is most of our global funds, pensions, etc., will be invested at least 65% in the S&P 500. So what we do is look at we look at some global indicators for global funds, but also at the S&P 500, which is a very good proxy. So that's bullish. Yardeni.com is an excellent resource as well. So this one is on a global basis. So MSCI global index, global forward earnings. So it's forward-looking forward earnings. So this one is actually split between the US and the rest of the countries in the world. So it'd be Europe plus there's some emerging markets, about 10%, 8% so emerging markets. We can see that it's the US that's pulling our global funds up at the moment. The rest of the world has been struggling since 2021. So that's why our global funds are 65% in US stocks, and that's what's given us the increases recently. And of course, what we do is just track to see if that's going to change at all. So, so forward earnings there, because of the US, is looking healthy. So the S&P 500 real earnings yield and bear markets, this is actually a sort of bear market indicator as well. So this, as you see, the dot-com bear market here and the Great Financial Crisis bear market here. When it goes below zero, this real earnings yield, it's pretty good correlation, as you can see, at zero with these bear markets. So obviously COVID, we came down quite a long way there. We bounced back up. Now this chart's going back quite a long way, 1940. So there is actually a sort of downturn here that we're seeing, a very slight downturn after this bounce back to almost 2 here. So again, we just got to track to see if we go below zero, then that would be a warning sign that we could be heading up into a recession. And as you can see, we're just pointing down at the moment, but so we're tracking that. But currently, we're on sort of this upward trajectory. So we'll either go back down, and there'll be a problem or recession here, or we may go down a little bit, come back up, and happy days. But currently, we're not below zero. So again, you have to say that that's a bullish sign. Another bullish sign. Another one, S&P 500 forward earnings, nominal versus real, both going up after going below zero. Here again, you see below zero. Great financial crisis, below zero. .com bust. Obviously, COVID, we could sort of discount that, although that's obviously distorted markets. But anyway, so we're coming back up here. So again, you have to say that forward earnings nominal versus real chart is bullish, at least in the near term. And then finally, the Yardeni.com. If we just go back up here, the earnings outlook or earnings forecast. Again, it's another bullish one. So you can see in 2022, this is actual and estimated 218, and the year on year here is in the second column here. So 2022, 4.8, 218 sort of level. 2023 actual was 220, 2.2, and then 2024 here is 250 and 12.1. That's estimated. So we'll see. It may be bullish, but 2025, 270, 2026, 300. So again, 8 year on year and 11 year on year. So that's pretty bullish. But Yardeni is actually very, very well respected data for this kind of thing. So for what it's worth, again, bullish. That's bullish. For stock markets, Y charts, again, another excellent website here. There's all sorts of indicators and financial statistics that you can look at here. But again, the S&P 500 earnings per share forward estimate here. This has this is from Standard & Poor's, so you provide the S&P 500 index itself. So even they've got going up to the end of 2024, earnings projecting up, and then a slowdown, potential headwinds here, indicates the future estimates for the composite earnings per share for the S&P 500. So we've got some kind of potential slowdown that Standard & Poor's seeing here, and then going up from the second half of 2025. So we'll see about that. They could be wrong. They could be that could see this continue down if this downturn in 2025 does materialize. As I say, it's exactly the kind of thing that we'll be tracking on Boom Bust Invest in these updates. Another one here at multiple.com, just to show that you've got 2023 is a good year. Obviously, 2022 with the inflation problem was a bad year. But again, just to show that if you're a buy and hold investor, this is this kind of thing where you're trying to avoid these downturns is entirely optional, of course. In 2008, minus 77, 2007, minus 18, but then in 2009, plus 242. So these markets, they do come back. However, the S&P 500 between the year 2000.com bust, in terms of stock market performance, we didn't see a break even until about 2012, 2013. So yes, earnings can bounce back, but the downturns, if they're bad, can be drawn out over 4 or 5 years per major crash. So hence you want to try and avoid them. But things do bounce back. So even if you do get caught out by one of these big crashes, it's not the end of the world necessarily. So moving on to the conference board. Again, this is one of the main leading indicators for that people will look at to see if we are heading into some sort of downturn. So conference board latest release here, over a 6-month period between October 23 and April 2024, the LEI contracted 1.9%, So a smaller decrease than the 3.5% decline over the previous 6 months. So the picture is sort of improving in terms of this LEI's leading sort of blend of leading indicators, year-over-year growth rate turning up. But as you can see, it's coming from a very low base here. So this is the 2008, 2009 crash. This is the dot-com bust. So we were at similar levels to the dot-com bust and COVID here. But without seeing the grey bars, which are the recessions, apparently. So as long as that keeps improving, then it points towards an improving picture for stocks and bonds. As you can see, the black line is the year-over-year real change in GDP. Just looks like it's keeling over here. So, if that were to sort of turn down, as you can see, it turns down when we see these recessions. So if that does turn down, and this potential recession we see in 2025, we need to keep an eye on that, which would probably mean that we'd see this LEI indicator also rolling over. That's the kind of thing that we'll be looking out for. But at the moment, it's on the way up. GDP is on the way up. So there's no sort of cause for panic there with this very well-respected economic indicator here. However, this is worth reading out because everyone sort of listens to these guys' conference boards. So let's see what they've got to say. So another decline in the US, LEI confirms that softer economic conditions lay ahead. So a deterioration in consumers' outlook on business conditions, weaker new orders, so demand is going down, a negative yield spread. We're still in negative yield curve inversion, and a drop in new building permits fueled April's decline. In addition, stock prices contributed negatively for the first time since October of last year, while the LEI's 6-month and annual growth rates no longer signal a forthcoming recession. So there's no signal for a forthcoming recession, according to the LEI. They still point to serious headwinds to growth ahead. Indeed, elevated inflation, high interest rates, rising household debt, and depleted pandemic savings are all expected to continue weighing on the US economy in 2024. As a result, we project that real GDP growth will slow to under 1% over the Q2 to Q3 2024 period. So, if we go back here, that would they think that this is going to sort of turn down to around about 1. So we'll have to see. In which case, we could well see a recession. If then that goes down, dips down below 0. Moving on to the global economic outlook, again with the conference board. So on saying that, they're saying something different here, which is that the global real GDP forecast for 2024-25, so this is on a global basis, one change in April, we continue to project that the global economy will grow by 3% this year and by 3.1% in 2025. So overall, the global growth, global GDP, according to the conference board, their analysis is that we'll see growth in 2025 as well. So overall, it's bullish for stocks in the coming year or so. A few others here. So isabelnet.com, and then another excellent sort of free resource. So the FMS recession expectations. Let's take a look at this. While economic indicators are currently showing resilience, is it unlikely that the global economy will experience a recession in the next 12 months? So according to this fund manager surveys, you might not be able to see it too well, but this is a Bank of America Global Fund Manager Survey. 78%, so the majority, say that recession is unlikely in the next 12 months. So, I mean, it's their fund managers' jobs to try and get these calls right. And so they are bullish in general. and they say a recession is unlikely. Could be wrong, but the majority are not calling a recession. May 31st, probability of US recession calculated from the yield curve. So this is from the Federal Reserve of Cleveland. The probability of US recession calculated from the yield curve, the probability of US recession in 12 months, it stands at 54%. So, that's pretty high. That's kind of 50-50, really, I think, whether we actually see a recession or not. So, yeah, it hangs in the balance, really. We could see it, and if we do see a recession, then we will see declines in stock markets. And in that situation, if I was to see this to materialise, then I would sort of deallocate from stocks, probably towards bonds, or at least rotate some stocks into bonds. Another very accurate indicator here, again from isabelnet.com, is US heavy truck sales. Going back to the 70s, we see this peak before these grey lines, which are recessions, every time about a year or year and a half before. Most recently, we've had a similar level of high truck sales, which have now declined. If each time before a recession, it's gone down into this sort of lower sales, amber and green territory. So we're not there yet. It's still maybe a sort of a lower high there. A higher low. If we see that continue up, happy days. If we see this continue down into the lower sales territory, then every time that's happened, going back to the 70s, we've seen a recession. So this is actually one of the best indicators. For some reason, it's the economy is very sensitive to these heavy truck sales. So if that continues down, again, if you like and subscribe, so I'll let you know if these indicators are heading towards a recession and a potential downturn in our stocks, financial markets. A few more here then. So this one from the St. Louis Federal Reserve in the US. And we see, this is sort of amazingly accurate. There's the Great Financial Crisis. So this is sort of a blend of indicators and indexes that will sort of spike up when we're entering a recession. There's .com, there's Great Financial Crisis, there's COVID. And as you can see, we are, according to this, it does change quite quickly. But at the moment, we seem to be nowhere near that recession probability. However, this is another often quoted SARM real-time, the SARM raw recession indicator, which is basically a sort of unemployment momentum indicator, and that is ticking up. So and as we'll see here, unemployment is going in the right direction. Again, you can see .com bust here. It just starts ticking up here just before the Great Financial Crisis starts ticking up, and we are seeing the start of it in a kind of similar level, an uptick in this SARM raw recession indicator, which, as I say, just is effectively a measure of the rate of change of unemployment. So if we this is going back to 1950. So as you can see, it's pretty accurate. If we so this is before the Great Financial Crisis. You can see it's about 0.4 there, and at the moment we're at 0.4, nearly. So again, another one to keep an eye on. If this goes up above 0.4, 0.5, 0.7, then we're into what should be a recession. So we're sort of heading in that direction, according to this. This is often quoted, quite well respected, and as you can see, going back to the 50s, is pretty accurate. That saying, we're heading in the wrong direction at the moment. So we'll have to see if that turns down or keeps going up. Keeps going up, then we will likely see this recession in 2025. Unemployment, then finally, take a look at these unemployment based. This is a job losers, not on layoff, which seems to be slightly more, again, sensitive to changes in unemployment. And we'll see that ticking up as well. So that sort of coincides with this uptick in unemployment. And we see again before the great financial crisis, see it ticking up before the dot-com bust, before the recession in the 90s, going back to the 80s. So again, another good indicator here, and it is heading in the wrong direction. On trading economics, again, another great website with lots of free data. Again, non-farm payrolls, the big one from the US. US economy added 175,000 jobs in April 2024. Sounds good, but it's a deceleration compared to the upwardly revised 315,000 jobs added in March, and falling short of market expectations of 243,000. So 175 actual from an expected of 243,000. So I mean that's a bit of a warning sign. Though you do see, I think you do see sort of seasonal drop-offs here. So possibly it's seasonal. I'm not sure. Longer term, yeah. So we'll have to see if that continues or not. But certainly, it came in well below expectations. And so finally, again, this is Statista.com, another good site here. And we'll see here that the unemployment rate, again, just ticking up. So it starts to go down here in March, but it's ticked up again in April. Trending in the wrong direction. Again, so we just have to see if that continues. If it does continue, then we're heading into a greater probability of seeing a recession. So I mean, and so as you can see, this is the overall picture where we're at an interesting point now. If we do see these indicators continue up, it's likely we'll see our stocks come down. So as I say, just track this every quarter. If you subscribe, hit the bell icon, you'll get the notifications for these videos, and you'll be the first to know.